Thank you very much, everyone. I just want to say this is Richard Fisher, President of the Dallas Federal Reserve. Richard, it's great to see you.
Thank you, Maria.
Yeah, it's always hard when you've got lots of people coming at you all the time asking for your opinions, and we know how busy you are, and it's really great to sit down with you right now in such an uncertain and important time for the economy.
Well, I appreciate being here, and I look forward to our conversation.
Great. So I guess let's kick it off with your assessment of where we are, because there are so many moving parts, and it seems like the markets are moving on every headline coming across. So let me kick it off there. How would you characterize this recovery right now?
Very slow and painfully slow. In fact, I'm going to put up a chart here, if we can, that'll show you where we are in terms of the gap. If we keep growing at the current rate of employment growth, and that's what we care about, putting people back to work, inflation is under control for the time being. We're running inflationary rates around 2%, a little bit less, which is our goal at the central bank, at the Federal Reserve. But this chart, Maria, shows you that if we expand at the present rate of expansion, it's about 139 or 138,000 jobs a month. It'll take us till May of 2015 to get back to our previous peak employment levels. This is not satisfactory. The issue is, as referred to by our introducer of Mr. Skinner here, how can we change the pace? And what is the role of monetary policy? And what are the agents that are responsible to help accelerate this pace? Because we went through a huge gap down during the financial crisis, 2008, 2009.
I want to get into this because many of you may or may not know, Richard's background is a business background. And I think because you have a business background, you really approach monetary policy and approach economic issues differently than some of your colleagues. So I do want to get into that and certainly about your views on monetary policy. But let me first follow up on this chart. Why have we seen one of the slowest recoveries in recent decades? I mean, everyone you speak to will say that we should be at a much farther along point in terms of this recovery than we are. What's the problem?
This is one of the great puzzles because we have poured on monetary accommodation. Let's use a simple analogy. We have filled the gas tank. There's plenty of liquidity out there. We have $1.5 trillion that are on deposit from private banks in the 12 Federal Reserve banks. That's where private banks put their money, their excess reserves. We pay them 25/100% per annum, as you know, not very much. In the S&P 500 companies, we figure there are about $2 trillion of excess cash flow sitting on the sidelines, not being put to work in terms of hiring more people and committing to more capital expansion. And then in the non-depository financial institutions, we have 600 to 800 billion. No one really knows what the numbers are. A lot of money, a lot of cash sitting on the sidelines. Why isn't it being put to work? We've made it possible. We've put it there through monetary accommodation. Why aren't businesswomen and businessmen, public and private, large and small, going out and expanding their operations? Well, you referred to my background. I don't have a PhD in economics. I'm very proud of the fact I don't have a PhD in economics. I have an MBA and I ran money for a living and I worked for a bank. Imagine that, a banker at the Federal Reserve. Very odd. You do best when you limit the uncertainty you operate under. All businesswomen and men operate under conditions of uncertainty. But when you have maximum uncertainty, you go into, I'll use a Clintonism here, a defensive crouch. And if you don't know what your cost structure is going to be, and you have reasonable doubt about the growth of your top line, sales, revenues, and where demand is going, you freeze. I don't care how much money you have sitting on the sideline. And I believe that's what's happening now. We don't have clarity. We haven't had it for some time in terms of what incents businesses to take the gasoline that we have filled the tank with and step on the accelerator. John Maynard Keynes called it the magneto. To engage the transmission of job creation. Something's wrong. We were knocked down severely. We know after severe financial crisis it takes a long time to recover. But the pace of recovery, as shown in this chart, is way too slow. So let's say the Maria Company. You know that you can go out and borrow money for almost nothing now. It's fairly readily available. Why aren't you borrowing it? It's hard for me to understand as a businessman why you would when you don't know what your tax rate's going to be next year, when you have no idea how federal spending is going to affect either your customer base or you if you're dependent upon a portion of it, or indirectly or directly. If you have no idea what it's going to cost you to insure the health care of your worker, we got a little more clarity on that today, but we know that this will be a battleground issue for the presidential campaign. In the meantime, you keep hearing and worrying about what's going on in Europe, where we export 13% of the exports of this country, a slowdown in China, which has become a market that we have become much more integrated with, a consequent knock-on slowdown in Latin America and Australia and elsewhere. We are big exporters to Latin America, particularly to Brazil now and to Mexico. So amidst all that uncertainty, people are just sitting on the sidelines. And then you have one other thing that's occurred simultaneously, which is we're riding up Moore's curve. That is, productivity has been enhanced enormously by technology. So this is going to be a snail's pace. Now, there are parts of the country that have outperformed others. I come from one of them in terms of job creation. But as a nation, we're way behind. And we have run an accommodative monetary policy. I believe that if you depend too much on monetary policy, it gives excuse to the, and I'm going to use a harsh word here, the misfeasance of Congress. We've had generations of Republicans and Democrats. This dug a deep hole for our children. Spend, spend, spend. Don't think about how you're going to fund unfunded liabilities. If we make up for that as monetary authorities, that's the road to Weimar. That's the road to Argentina. That's the road to nationalist China. And we don't want to be responsible. I certainly don't want to be responsible for that.
You've said a lot of things there. We're talking about a strong corporate sector. Some estimates calling for cash on balance sheets of $3.6 trillion right now within the S&P 500. And they're not spending that money aggressively, adding new heads to the payroll, because they're uncertain about tax policy. I want to delve deeper into that. And I also want to talk about your views about monetary policy. But let me get your take first on health care. Today, we get the Supreme Court upholding the president's health care legislation. What kind of impact or implications do you envision as a result of this?
Too early to tell. Again, I think this will be an issue that will be debated through remember, this starts in 2014. So
but does the
court
start
made
right
a ruling.
away?
No, the whole program begins in 2014. And again, I'm not an advocate for either side. I stay away from politics completely. I'm just critical of the class in its entirety. So I'm totally nonpartisan. You check your partisanship at the door when you come to the Fed. And that's one of my proudest aspects of our institution. But there are a lot of unknowns. For example, the Medicaid portion is a huge dollar expense. Some states will run Medicaid and up to certain levels of poverty. The ruling is actually 130% of the poverty level. In Texas, it's 27%. In California, it's 103%. If people come up to the maximum level, they're not required to, and this was a key part of the ruling. The Supreme Court ruled that a state has a right not to. But if they did, it would cost the American taxpayer another $480 billion between 2014 and 2019. That'll be interesting to see how that plays out and what kind of fiscal pressures it puts on not only the states, but additional pressures on the federal government. But Maria, to be honest with you, this is new. We need to think through this thing. And I work for the Monetary Authority of the United States, not for the Fiscal Authority.
So let's talk about the Monetary Authority. You dissented twice, I guess, in the last couple of years in terms of some of these stimulus packages.
I think more than that.
More than that, for sure. But just in most recent couple of programs, Operation Twist, QE2. Now we've got, expectations or calls for QE3. Why are you so against the Federal Reserve being there and bailing out this economy?
I'm not against the Federal Reserve bailing out the economy. The question is efficacy. What works and what doesn't work? I mentioned earlier we have a lot sitting on the sidelines. Question, why would you add to that if it's already sitting on the sidelines? Operation Twist, for those of you that aren't familiar with the terminology, is moving out the so-called yield curve. That is, we have a big portfolio at the Treasury, at the Fed. It's our balance sheet's almost $3 trillion now, $2.7 trillion. It was $800 billion when we started the crisis. We have been buying longer-term securities. Typically, we hold very short-term securities, and we've been moving out the so-called yield curve. By the time we're done with the program that the committee just agreed upon, which I argued against, but I was in a minority, it's the nature of deliberative bodies, The majority ruled for it, and that's the way it works and the way it should work. We will end up having 30%, a third, of all treasuries between the maturity years of 6 and 30. We will end up having no maturities between 3 months and 3 years. One of the benefits of owning treasury bills and notes is that they roll off. In this case, we're going to have to make a very tough decision at some point to get out of those. And if the economy picks up as we hope, we'll get out of them at higher interest rates, meaning they'll be marked down in price. And I'm not sure what the consequences of that are likely to be, which is why I argued against it. Moreover, we have so much money coming into the country now because of the European situation and elsewhere. It's an ugly analogy, but I like to use it, which is we're the best-looking horse in the glue factory. And because of our relative performance, a lot of foreign investment is taking place in treasuries. I think that's had a greater impact than what we've been doing at the Fed in keeping rates low. And the real concern I have is the exit strategy. We can build up this big portfolio, but what happens when we need to get out of it? And what will be the inflationary consequences of doing so? Those are big question marks. We have theoretical answers. No central bank in the history of the world has ever done this on this order of magnitude. And coming back to my background as a business guy, I have to automatically think about execution, not just theory. And that's why I've been a little pig-headed on this issue.
But you know, backtrack a couple of years when we were sort of in the throes of the financial crisis. Do you not believe that the Federal Reserve was really needed in a big way? I mean,
Sure.
you had companies like GE worried that the lights wouldn't go back on back in 2007, 2008. Was it appropriate then?
We put in place what are called exigent programs under a law that is no longer. Section 13.3 of Dodd-Frank took that away. But what happened then was different, and I did support those programs. We had a total failure in interbank lending. The commercial paper market, the most basic instrument of finance, came to a halt. Asset-backed securities marking stopped. And then we had a money market mutual fund, the first found in the United States, as you know, broke the buck. We are the lender of last resort. All central banks are. We had to create these programs, step in, recreate those markets, get them going again, revive the patient. And when the patient was ready to get off the table and walk, which it was, we got out of that business. And again, this is very unusual in government. We not only did what we said we were going to do, very rare in government, but we made money for the taxpayer. And then we closed them down. Extremely rare in government. We started something and closed it down. So those were special programs. I think it's noteworthy that under Dodd-Frank, the new legislation, we will no longer be allowed to do that unless we do it on a very broad scale, which raises the bar, rather than dealing with these specific micro components of each one of those marketplaces.
I think you make a great point by saying, you know, $3.6 trillion of cash on balance sheets, when you've got all this sidelined money, why are we adding more to it?
Right.
Get these companies to move that sidelined money, put it into the economy. So what do you think would be the best way to get that money moving again? Talk to us, and I recognize that you are focused on monetary policy, not on
Right.
fiscal policy. But from your standpoint, if not monetary policy, then what? What is it going to take, whether it's tax policy, energy policy, I don't know, to actually get managers of businesses to add heads to the payroll and get that money moving again?
I'm going to ask my assistant to put up a slide which shows by federal, well, let's go back to 1990. And we're going to skip forward on a bunch of these things here. I hope you'll forgive me for being parochial, but I think there's a lesson herein. This shows total non-agricultural employment over 22 years. Now, why do we say non-ag employment? This is a standard way of measuring employment. Agriculture represents 1% of the U.S. economy. We're big, but it's 1%, and 1% of our workforce. And typically, because it's seasonal, that's taken out. This is 22 years of growth, employment growth, and of course, I wouldn't show you this chart unless Texas were at the top, but look at the difference between Texas and New York. Over 22 years, New York and Massachusetts have a total job growth. This isn't compounded annually. Total, 4%. And look where we are. We're at 54%. We have compounded, if you see the black line in the U.S., at twice the rate of the United States. So we're growing our workforce at 2%. The United States, a little over 2%. The United States at less than 1.5%. Why? I would argue that at the margin, under both Democrats and Republicans in the governor's mansion, under Ann Richards, for example, and under Governor Bush, and legislatures that are Democrats and Republicans, we have just made ourselves more business friendly. We have a tax regime that, of course, has no income tax. We have a regulatory environment that some people may object to, but it is more business and job friendly. And people have been attracted, and I could show you charts that show the correlation between investment that flows into Texas and our job growth. That tells me, oh, let me add one other thing. We have the same monetary policy as the rest of the United States. Same interest rates are paid on mortgages, same on C&I loans, commercial and industrial loans. Consumers pay the same rate to borrow. Why are we outperforming the rest of the country? It tells me that at the margin, what we do on fiscal policy has an impact. But that's at the state. And incidentally, we have a legislature that meets for 140 days every 2 years. Now, there's some people that wish it was 2 days every 140 years, but I don't think we're going to get there. Fiscal policy of the United States is a dominant influence, even bigger than state policy. And I'm convinced, since we all have the same monetary policy, Texas, California, Illinois, New York, Massachusetts, that if we had a differentiation here of more pro-business, pro-growth, fiscal policy on the spend and tax side, then we would probably have much greater economic growth. And I think this underscores the point.
More business-friendly approach is what's happening in Texas. How can we look at that approach and emulate that on a national level? What kind of policies might actually move the needle in terms of moving that money?
Well, again, that's where I want to be careful, because I think it's important for our elected officials to make that decision. They have the power of the purse, and I'm talking about the Congress. People forget this. Presidents come and go. The Congress is there repeatedly. And it is the Ways and Means and others committees that control the purse. Under Democrats and Republicans, what they have done is they have created, over time, an enormously difficult environment, obviously, in terms of growing our economy and also recovering from the huge setback we experienced. So I'd like to see them, whatever they think is appropriate. It requires short-term confidence, but also requires long-term reinforcement of the fact that we're not going to go the way of the European countries, particularly Greece, Spain, Italy. We're not going to get stuck in the Japanese trap. Maria, I look at all this excess cash sitting around the world. It's not only here in the United States, we have it everywhere. And I say, I want it all for my people. I want it for America. I want it for American workers. And we now have to live in a different world than we lived before. We live in a globalized world. We won. We won the Cold War. The wall came down. The bamboo curtain was peeled back. We don't kill the Vietnamese anymore like when I was young, we were sent to war. We now sell their products. Every American baseball cap, or actually golf cap made with a little American flag on the side, almost every one of them is made in Vietnam. Imagine that. We trade with each other, we buy each other's securities, et cetera. So we now have competition for capital and competition for job creation. This is not a bad thing, it's a good thing. This is what we wanted. But now we have to create a tax, spend, fiscal, regulatory regime in the context of outcompeting others. And therein lies the problem.
Do you expect that to happen?
I'm an American, I'm the son of immigrants, I'm a believer in this country. Of course I expect it to happen, but I don't think it's going to happen easily. But I can tell you one thing that would make it worse is if we just run the printing presses at the Federal Reserve. My strong opinion is that that would be another disabling or confusing factor for businesswomen and men. And it would frighten them. And I think we have to be very careful. We are pushing the limits, in my opinion. And I don't want to add that as another factor of uncertainty. And very importantly, Maria, if you're an elected official, it's much easier to say, oh, just go print the money, than make the tough decisions of how are we going to cover our bills, what's the right tax regime, where do we cut spending. Look at this farm bill discussion that just took place. Very difficult stuff. If you feel the Fed or the central bank is just going to print your way out of it, let them do it.
Well, if you keep printing money, though, aren't you basically giving legislators, giving Congress, the White House, sort of a way out?
Yes.
An easy way out?
Yeah.
Not to make the hard choices?
I believe that.
Yeah. You mentioned Europe, and I know you've spoken about Europe. You gave a speech on Europe recently. I want to ask you about Europe because the ECB is in a similar position.
Right.
Printing money.
European Central Bank.
The European Central Bank. So what are your thoughts on how that plays out? And how worried should we all be about the European problems impacting the U.S.? You said a moment ago, 13% of exports.
It's a market for us. It's not an unimportant market. Obviously, it's 13% of what we sell. You have to sort of go through the entrails of those numbers because a good portion of that goes to Germany and the bigger countries rather than the so-called peripheral countries. Although 3% goes to Rotterdam and you're not sure how it's distributed. I mean, it would take a lot of work to figure that out. So it's a market for us. Secondly, we worry about the psychological contagion. I think our banks and our money market funds and so on have reduced their exposure significantly. One of the reasons they had that exposure is because we have a zero interest rate policy at the central bank, the Federal Reserve, and it's very common for people to reach for yield, and they put a lot of money in France and elsewhere to increase the yield on cash. That's now been pulled back significantly by the money market funds. So there is that risk of psychological contagion, and the real issue is a European issue. How are they going to get out of the trap they've set for themselves? They don't have a united fiscal policy like we do. Well, let me be less gentle. We have a problem with one Congress. They have to deal with 17 in the Euro currency zone and 27 in Europe.
It's a big deal.
So the European Central Bank, which is a new institution, we've been in business 100 years. We're the third central bank in the history of the United States. We have some experience now in dealing with this. This is all new to them, and I think Mr. Draghi and his predecessors are really severely challenged, but they're doing a very good job. And there are limits, again, given the nature of the fact that the Germans have a dominant role, have a natural phobia for inflation, it's in their DNA, as to how far they're willing to go. John Maynard Keynes said that it's much easier for markets to get rational than for sovereign powers to get rational. And I think it's going to take some time. That's going to be a very slow heal as well.
The numbers are really devastating.
Have a nice day. It's also pleasant.
We can show your chart of the numbers in Europe in terms of unemployment.
Can we put that up?
I mean, you've got Spain at 24%, right?
Right.
Really,
you can see Greece, the euro area. The thing that worries me a lot, if you look at, it's hard to see this, there's so many things on here. The Pacific Census Division, which is California and the Pacific Coast states, basically have the same unemployment rate as Italy. And that's where we're weakest in the United States.
California.
Well, California's the big daddy, or the big mama of that group. But it's up and down the coast, and that's where we're very, very weak. It's our highest pocket of unemployment.
So would the approach we're talking about, business-friendly, ensuring that businesses participate in the economy, spend money, would that also relate to what we're seeing here in terms of getting their arms around these very, very severe unemployment rates?
Well, again, we have challenges. We have new participants in the global economy. It's not just, when I was an assistant to President Carter, we had a G6. And what really counted was, what does the U.S. do, what does Japan do, what does Germany do? With all due respect to our Canadian friends and the Italians and so on. Now we have significant players in China and India and Brazil and Australia and others. So again, I think the whole world is going through a process of needing to modernize and reboot fiscal policy as we develop new institutions like the European Central Bank. But we have a new world to compete in, and also we have this incredible force that's come from cyberspace and the reallocation of specialization. These are big issues, and I think all governments are dealing with it, the Eurozone as well as the United States, and these emerging countries as well.
But in terms of the debate, austerity versus stimulus, this is the debate that they are living with every day. Mm-hmm. And in an environment where you've got 24% of the country of Spain out of a job and unable to get a job, do they need stimulus or should they stop spending? Austerity or growth?
Tough issues for their lawmakers, for their fiscal policy makers. You have to bring unemployment down in the short term, but reassure the markets in the long term. Remember James Carville's great line that if he could come back as the most powerful person, it wouldn't be the Pope or the President, it would be as the bond market. And you know, the trouble with Spain now, of course, it's very difficult to fund their debt. Their short-term rates are extremely high. Greece's are extremely high. Markets are bloodless and brutal. And you have to, of course, meet up to market expectations if you expect to finance yourself in the public marketplace. Therefore, you have to have long-term promise, but you also have to correct your short-term problems. I have great sympathy for these lawmakers and what they're trying to do. But the answer is not simply to use the monetary tool. We are necessary, but not sufficient. And that applies to us, in my opinion, very strongly. It also applies to the European situation or any other country.
Do you think that your colleagues will follow this advice? I mean, so far, every time there's a Fed meeting, and Mr. Bernanke, who I know you have the highest regard for,
I do.
Speaks about this economy, we continue to see speculation that there will be more stimulus. So you have this view, you've been voicing this view, but do you think this view will materialize, or will we still see printing of money?
Well, first of all, I'm not alone. There are others. They can speak for themselves. I only speak for myself. You may have noticed that Mr. Lacker dissented in this last formal vote. There are other members of the committee who argue sometimes as I do and sometimes from a different approach with the same bottom line. And look, nobody on that committee, hawk or dove, wants to cross over the line. We know, and the chairman has been quite outspoken about this. No amount of monetary accommodation, he said, can substitute for what's needed from our fiscal authorities. And we have to be mindful of those limits. So we can't go on forever like this. It would be imprudent for us to do so. We need to see some tough decisions made by the Congress of the United States.
We know that Europe is where it is, and I know that you've spoken a lot about China as well. I want to get into your speech that you made recently about China, because you're seeing that that slowdown, and China has been the engine of growth for the world, and I'm going to get to that. But let me just ask you this. What are you and your colleagues worried about so much? I mean, not you, because you are saying you keep pushing back on all this stimulus, but why not just say, we've done enough? Now it's up to you. Now it's up to the fiscal side of things. What are they so worried about?
Well, it's our tradition that we don't speak for each other. I can only speak for myself. You just stated my argument. I think we've done enough. In fact, I would argue we've done too much, but that's a fine point. The real tough decision-making, and then I think we should drop this subject, has to come from the people that we elect to tax our money and to redistribute it. And to do so in a way that incents people. Whether you're a liberal or conservative is not the issue. How do you incent people to put our people back to work? And we know that we have the liquidity out there. We created it at the central bank. And businesses have saved and saved and saved. So again, ask yourself everything you do, how might I incent someone to go out and hire an American without resorting to protectionism and these things we know are so dangerous? And get your act together and get it done. Grow up.
China has been obviously a focus of attention for some time right now. It's even created a debate about whether America is losing its mojo and other countries are growing much faster. How severe has the slowdown in China been in your view, and what are the implications of that giant engine slowing down?
Just a little background here. I've been going to China since 1979. I was part of President Carter's team that negotiated the settlement with Deng Xiaoping. And I remember in a meeting we had with Deng Xiaoping, his saying that they would grow at 8% per annum. Now, if you know the old Chinese system, that's remarkable because the abacus is a function of 7, so we couldn't figure out how he came to 8% compounded. He just pulled the number, I guess, out of the air. They have done that or slightly better. They're now at a point, I don't know if it's a complete stall point, but what an economist would call the middle income trap. They've moved up the value-added ladder. They supplanted the lower value-added part of the economy. Massive amounts of women and men put to work, picking up the common labor and those kind of things. Now they're moving up the value-added ladder. The question is the transition. And then what incents their people to make that transition? You moved a lot of people from the interior to the coastal areas. They exported like crazy. Cheap products at first and then better products and better products. But right now it seems that they are slowing down. And the real issue is going to be how do they make that transition to the higher value-added area? And how do you do it with the form of government that they have? I've been to China so many times I cannot remember. And I think you know that I was made in China. My parents left Shanghai just at the last moment. I was born a couple of months later after that. So I've always had an interest in China. I follow it very closely. There's a certain level of official corruption and inefficiency. The accounting numbers are very undependable. My druthers tell me that they're probably growing at less than they state. But the real issue now is how do they go, having gone from a period from Deng Xiaoping onward, basically from 1978 onward, 1980 onward to now, and make the next leap without liberalizing their society and making it possible for not just the princelings and those that are favored by state-owned enterprises and so on, but for the people to participate in that economic miracle. They have done a great deal. I'm very impressed with what they've done. But I think this next step will be the most difficult of all.
Well, moving from an export-led economy to a consumer-led economy obviously can't be easy, and it's a long-term process. Where are they, do you think, in that process?
They're just beginning. They have still, as we do, by the way, several too-big-to-fail institutions, state-owned banks that need to become much more efficient and much more commercially and instinctively driven. And they have a real estate bubble that they need to slowly deflate. They seem to be going about that. And then the question, too, is can you have a consumer society when you have such restrictions on social behavior? I don't know the answers to these questions, but I think that's the challenge the Chinese people face.
Is this one of the worries that we should be focused on in the United States, that China is slowing faster and more than we really know or expected?
Well, I mean, we worried about the margin. Again, to go back to my part of the Federal Reserve District, which is 96% Texas, parts of Louisiana, parts of New Mexico, we're the biggest exporting state. We pulled ahead of California 7 years ago. With the Panama Canal, it'll make us even more prominent in the Gulf area. And our fastest growing market has been exports to China. A lot of electronics, a lot of high tech, of course, agricultural products and so on. And chemicals, huge, because we have 60% of the refinery business in the United States in my Federal Reserve District. So we want them to be growing as a market. As you know, they own a pretty good pool of U.S. Treasuries, not unimportant. They've helped us keep interest rates down. They've been aggressive buyers. They continue to be buyers. So it is important, I think, for the world and our own economy, that they continue to grow. And that they get through this little soft patch that they're going through. They're still growing at better rates than we are, obviously. But they have a lot of mouths to feed. I remember when we were with Deng Xiaoping, we asked him how many people were in China. And he said, at that time, 900 billion. And an aide leaned over, whispered as he said, I'm sorry, I was wrong, 1.1 billion. So 900 million and 1.1 billion, just a little rounding error. Yeah. It's amazing. So we hope that they will make this transition, have a healthier economy. It's good for the world. It's what we want to see.
I remember in Hank Paulson's book when he wrote about how China and Russia had a conversation, the leaders of China and Russia during the financial crisis, to try to bully America and into doing what they wanted to do. Otherwise, they would start selling some of those holdings aggressively. Do you worry that they could bully us into forcing interest rates up or forcing America to do something, given that they do own so much of our securities?
No, I think they'll invest according to prudent investment measures. I wouldn't want to be the head of the Bank of China if I took a loss on my portfolio or if I missed something. So, and again, we're the most attractive place for sovereign credit risk. And I just don't hear anymore that the Euro system's so much better. This was a fad, an intellectual fad we went through for about a decade, actually starting with Mr. Kennedy's book, The Scholar at Yale, that Europe was going to take over from the United States. We don't hear that anymore.
No, we certainly
and you don't see it in the
days.
marketplace either.
Right.
So I think they will invest according to prudent standards, and I don't worry about that. In fact, I take comfort in the fact that they buy our treasuries. It's a good thing. It shows how integrated the global markets are. And I believe they will follow market discipline, just as Singapore will, or the Swiss will, or the Canadians, or the Mexicans, or anybody else will. That's what we do these days.
Switzerland and Singapore, among the most competitive countries out there. Small countries, but competitive. Do you think that's because of the business-friendly approach there as well?
There was a piece the other day in the newspaper. Singapore has more millionaires per capita than any place else. When you think about it, it was a swamp when Lee Kuan Yew, people have some dispute about the way he managed, but when he became the leader of Singapore, it wasn't very long ago. It was in our lifetimes. So, but these are small entities, but very strategically smart. The Norwegians, that's probably the richest society in the world. That's due to one product, energy, but also prudent management. And I think they are examples. I can't really take too much comfort in these smaller countries We're unique in America. We're huge. We lead the world. We just have to figure out a way to continue to do so. And it's hard to take examples from these smaller countries. However, we do know that capital is attracted to them, and we have to remind ourselves, if we're going to create a tax regime, it has to compete with people like that. And there are plenty of them around the world. And I think there will be more so, particularly as the Europeans try to figure their way out of their current trap.
Let me switch gears, ask you a little about regulation. Today, of course, we wake up to a story and speculation that the trading loss at JP Morgan could be as high as $9 billion. So we're all trying to figure out really what is the value of this loss. Is it $2 billion, $5 billion, $9 billion? What's your take on that?
Well, I'm going to ask my colleagues to put up a little chart here in terms of, you're talking particularly about the large institutions. But let's first stop right there. Go back. You asked me about regulation first, so let me show you this little pie chart from the Harvard Business School. This was a study done by Roger Porter, a very good, brilliant economist, and one of his colleagues. And what it does is it surveys living HBS graduates who are all in pretty good positions and the CEOs of companies as to what inhibits them from further job creation. It's one of the better studies done. And look at those two big pieces in the pie, regulations and taxes. And then what is very worrisome to me is that middle section on talent. I don't see monetary policy up there. That could be part of macroeconomics. But over half of the inhibition to hiring new people are regulations, talent, and taxes. It tells you a lot. These are people that operate businesses, that hire men and women, that advance our society through the private sector. So that goes to regulation, which you asked. Now, with regard to, you just mentioned JP Morgan. That has to do with what I consider to be one of our biggest problems, which are institutions that are considered too big to fail. And we have done a lot of work at the Dallas Fed on this. I would urge you to go to our website, by the way, because we take a rather radical view. Our view, which is bred of a lot of analysis and just an unfortunate conclusion, and that we think the least worst option is to break up these large institutions. We put this out with our annual report in March. It has since gotten an awful lot of play. Just on 2 days ago, Mr. Purcell, who ran Morgan Stanley, had an incredible article in the Wall Street Journal and walked through a market solution that shareholders should be demanding greater value from these very large institutions. You happen to mention one of them, but without picking on them by name. These are inhibitors, by the way, of the efficiency of monetary policy. If we're so worried about whether someone's going to fail or not, management becomes worried and they also go into a defensive crouch. So we have a cultural change that I think needs to take place. We have 5 or 6 institutions that dominate well over half of the deposit base in this country. It's worse after Dodd-Frank than it was before Dodd-Frank. And I do think, without going into that specific transaction, I want to show one more slide of someone who I respect enormously, who just passed away, Anna Schwartz. And she basically says, and had said, and this was quoted in her obituary written in the Wall Street Journal, that bottom line, basically that people that make bad decisions should go out of business, and they should pay the consequences, be punished, and those that make good decisions should be enriched. We have it backwards. And I do believe all this exercise about too good to fail and what came out of Dodd-Frank won't do the trick. And in fact, it enshrines too big to fail institutions. And my bank takes a totally different view.
Why is it worse now after Dodd-Frank in terms of too big to fail?
Well, part of it is because we did have a crisis and we allowed certain institutions to be blended into others. You know what they are. Also, there's an implied subsidy. If you're too big to fail, you as a depositor will feel, or as a shareholder, or really as someone does, you'll feel more comfort. They have a funding preference. And if you look at the costs of funds of these large institutions compared to a local bank here in Aspen or a regional bank in Dallas, they're much lower. So it's an unfair subsidy. And if you have a subsidy, you're going to do a little bit better than the competition. So I think we need to deal with this thing, and I would add as one more note. One of the reasons Japan, in my opinion, another country I spent a great deal of time in, could not come out of the crisis that they came out of, despite abundant liquidity provided by the central bank and interference in many more markets than we've been involved in at the Fed is because they never cured the problem of their too big to fail banks. They still remain inefficient. And I think that sort of clogged up the monetary transmission mechanism. So this is an issue I think we really have to deal with.
You know, I'm going to open it up to questions in a moment, everybody, so I hope you will ask Richard your questions and give us your insight. But putting sort of one specific name aside, JP Morgan with the trading loss there, the derivatives portfolios out there, how worried should we be that there are all these unknowns in some of these derivatives portfolios and that it could go any way at any bank?
Well, what I worry about is protecting the depositors and not spending taxpayer money to bail people out who get in trouble. We have a system where we provide for insurance for people that want to safe keep their money. Where do you safe keep your money? In banks. And really what Sandy Weil figured out, which was extremely smart, not that he's a bad guy, he understood the system, was that you could take that cheap subsidized money and take risk. And one of the things, Maria, this may be difficult it's sometimes hard for me to understand, but I look at this as my former professional life. I managed money. I was a banker. When you're a banker, you're much more balance sheet oriented. When you're an investment banker or a hedge fund manager like I was, you're income statement oriented. You really care about what you make every year, and you ramp up your institution to do that. There's a clash of cultures, and these cultures are utterly, completely intertwined in these large institutions. I think the best thing to do is to separate those cultures. And I'm not alone. Even Phil Purcell, who ran Morgan Stanley, and Anna Schwartz and others who are much more reputable than me have basically concluded the same thing. I'm not saying we go back to the law that inhibited the two cultures, not inhibited, but separated the two cultures, but I think we're going to have something like Glass-Steagall again.
So, Glass-Steagall meaning you've got to separate these businesses.
Glass-Steagall 2.0.
Yeah. So in other words, the top banks in the U.S., JP Morgan, Bank of America, Citi, they are too big to fail.
They're considered too big to fail, yes. And they're not alone.
Questions from the audience? Yes, sir. There's a microphone right behind you.
Has any serious thought been given to monetizing the debt at a time when inflation is very low and the national debt seems at least very difficult to resolve? Is that something that your people have studied?
It's something we want to avoid. That's the road to perdition. If you monetize the debt, you are on the road to hyperinflation. We've seen this, we know this historically over and over and over again. So if you mean we should just continually print money ad infinitum, nobody thinks that way that I'm aware of in my committee, and I certainly don't think that way, and I would object to it. You should never monetize the debt.
More about getting the debt down to a more manageable level. And again, if you were ever going to do it, it would be at a time when inflation is low and our industries are operating below capacity. There would be the possibility, at least, of being able to do it. And my thought really is more, it may be the only answer.
Well, if it's the only answer, we have gotten ourselves into a hole we'll never get out. Again, the only way to deal with our indebtedness and our unfunded liabilities, and I want to give you an example of an unfunded liability, Medicare. We at the Dallas Fed calculate that the present value, that is, we paid off everything that's been promised to the American people under Medicare today, $90 trillion. That's what your legislatures have done to you. Should we print that money, or should we have them corrected? To me, every time you see a central bank in history who's gone down the path of monetizing obligations to that extent, you have ended up with hyperinflation. This is the history of the world. So I don't believe in monetizing the debt. Already, we at the Fed own a big portion of treasuries. I mentioned earlier, we'll be after the end of this program, almost a third of the longer-term maturities of treasuries will be in our portfolio. Markets need these instruments because they're the safest instruments to trade in. And it then interferes with the proper functioning of markets and the arbitrage that goes off of those safe investments, such as U.S. Treasuries. So there's a practical limit as well as an ideological limit. I was just giving you my own ideology, but I think there's a practical limit as well.
Question right here, are you expecting an agreement on the fiscal cliff by the election? What does your gut tell you?
My gut tells me that there's going to be a lot of angst and argument between now and Election Day. And again, politicians will use this to their advantage on both sides of the aisle. I just don't see any resolution here for quite some time.
That's very dangerous, isn't it?
But you asked, that's my personal opinion. That's
Right,
not the
of
Federal
course.
Reserve.
It's
It's
your
not the
personal
Dallas
opinion.
Fed speaking.
We understand.
Yeah.
We understand. Yes, sir.
I'm Richard Stroud, People Worker Society Europe. I have a question or an observation regarding the lack of
But it's a good question so far.
The-
Jared, you can take the slide off.
regarding the lack of investment by corporations. It appears to be a systemic problem because slowdown, yes, but and uncertainty, yes. But corporations have been dealing for a long time with coping with difficult situations and uncertainty. This is what management is paid for.
You're exactly right.
But on the other hand, I think what we can see is a tremendous focus on short-term results, a lack of long-term perspective. Because if corporations would take a hit short-term in terms of profitability, they could make investments long-term. And I think the big danger of the current situation, which hasn't been really discussed, but I would be interested in your perspective, the big danger is that innovation may suffer badly, because if the investment is not happening, where will the innovation come from on a broad basis? So I believe it's a real systemic problem where it needs a very comprehensive perspective, including the markets, how the markets react, the pressure on corporations for short-term results, the fiscal policy, et cetera, et cetera.
Sounds like the U.S., by the way.
I was going to say.
On monetary policy in the short term.
Yeah, it sounds like the federal
Super
government of the United
long-term.
States, short-term gratification and not thinking about long-term consequences. I disagree with you in terms of the way businesses operate.
You disagree?
Absolutely. I do think that I've been on compensation committees of different publicly traded companies, and I do think we may have distorted decision-making, and you may be right in terms of correcting that cultural bias. But any good businesswoman or businessman thinks long-term. I don't want to embarrass anybody in this audience. There's somebody in this audience who's built one of the great auto dealer franchises in America. I know this family like brothers and sisters. They're always thinking very long-term, even though they make a good deal of money short-term. And I don't see how you can succeed as a business person unless you are plotting over a multi-year framework. Now, the way the trading markets work and the way a lot of what Maria comments on every single day and is so good at, we tend to think that, every business person is sitting there just worrying about the price of their stock every 30 seconds or nanoseconds. I don't know many business operators that operate that way, either here or anywhere else. There are some.
Every quarter.
And quarterly focus, you're right, is awfully myopic. But you know what? You can work to that mark, but if you don't perform over the long term, you're not going to keep your job. But I'm a public servant. What I'm really worried about is the culture you just expressed, the proclivities you just expressed, are rampant with our fiscal authorities. Short-term gratification, digging long-term holes. And I'd like to see that corrected. And there's no way to correct it through monetary policy. We, too, have to think long-term. And this is one of the things I think is great about the Federal Reserve and a good central bank. We have to think about the long-term consequence of what we do. And when we sit around that table, every discussion we have is the long-term consequences of what we're doing. What will be our exit strategy? How will we get out of this 10 years, 5 years, and down the road, or at the right time when it occurs? I wish that our elected officials had thought that way. I believe they're beginning to think that way, and now they have to make the tough decisions to implement that new thought process.
So what are some low-hanging fruit solutions as it
You
relates.
keep trying to get me in fiscal
no,
policy.
I'm not trying to get you to comment on what this administration or another administration should be doing.
Right.
Just trying to get some sensible, practical ideas on the table as it relates to Social Security, Medicare, and Medicaid, where we're spending so much money on these programs.
You do better when you collect more taxes. You collect more taxes when people prosper. When business prospers, they pay more taxes. We know, and this is just one area that's come to mind, and again, I have no fiscal responsibility. I'm not elected by the American people. I don't represent anybody. I'm a central banker, and I do my best in my profession. And I'm not elected by the American people. But were I elected by the American people, one thing I'd be thinking about is, again, how do I get a lot of that money that's outside the United States to come back and employ Americans? Well, that's one area under tax law
That's tax policy.
where you can make significant changes. The specifics of how you do that is up to our fiscal authorities. But I would like to see all this liquidity worldwide come here.
And you'd like to see the discussion happen.
Absolutely,
Yeah.
and I haven't heard that. The one thing I don't hear about when we talk about correcting our deficits, funding our unfunded liabilities, which are enormous, that aren't even on our balance sheets, is doing it in a globalized world. We're no longer an island. We have to compete against others for capital, for job creation, and I think our leaders have to think in those terms. It's a new world, and we can't just do this in separation.
Question there, all the way at the window.
This fellow right here.
Oh, I'm sorry, yes, go
You may
ahead.
have touched upon a little bit what I was going to ask, but when you sit around the table and you think about all these things, austerity and stimulus, what do you think about ways to balance the budget, and how do you feel about it? Because on one hand, when you're stimulating, you're creating more, putting more money into the marketplace, which may or may not help balance the budget. It may create more debt, more spending. So what do you think around the table about balancing the budget? Does the governors have any thoughts at all?
Well, first of all, it's not our job to balance budget. We're the
It's not
monetary.
just me who's bringing up this stuff. Thank you very much.
But I will tell you that we do have discussions of what the likely impact of government spending patterns will be on the economy. The old basic simple formula you learned if you took high school economics was our output was equal to government plus investment plus consumption plus or minus net exports. It's sort of a 4-variable equation. The G is government, and that's a big part of it. So of course we have to do our own best guesstimation. We have a staff briefing. We have our own staffs brief us in terms of where we think government spending and policy will go and how it's going to impact economic growth so that we can manage to that economic growth. But in terms of making decisions about or discussing how we would correct the problem, again, that's not our purview. That's what we elect Congress people and senators to do.
Yes, sir.
So 2 questions. Do you have a view that you could share as to how we should reform the housing finance industry in this country? And then secondly, how do you feel about the fact that we have 3 banking regulators and how effective a model that is to regulate the banks in this country?
Well, let me address the second one because the first one, again, gets into the issue of the people that make the laws that govern those institutions, and that's not my job. I think it's healthy to have freedom of choice if you're a bank. That is, if you're a community bank, you can be a member of the Federal Reserve System or you can be FDIC overseen. As long as the regulators work in parallel with each other, which we do, or we try to do. So I'm not as worried about that as long as we move all in the same direction. And there is a very conscious effort to do that now. Those that are the senior policymakers on the regulatory side spend an enormous amount of time together. We at the bank level, where we have the troops that go out and supervise and regulate banks, we have over 600 institutions we supervise and regulate in my Federal Reserve District under my bank at the Federal Reserve Bank of Dallas. We're in constant contact with the other regulators as well to see what we might do that would encourage a bit more effective transmission of monetary policy. So I don't have a problem with having a couple of regulators. Dodd-Frank did do one good thing, which is it sort of tightened that circle a little bit. It put the thrift holding companies under supervision of the Federal Reserve, and it gave us some broader powers. Originally, it did not intend to do so. It intended to diminish our powers. And if I can give you a little plug here, It was thanks to a Texas Senator, Kay Bailey Hutchison, that that whole process was reversed, and indeed the Federal Reserve ended up with greater supervisory powers over a broader purview of financial institutions. I think that's a good thing.
The Fed has said that rates are going to stay at very low levels until 2014. I know you said to me today, rates will start moving when the economy starts improving. But realistically speaking, would you...
That's good alliteration.
I'm sorry?
It's good alliteration. But go
Thank you.
ahead.
Thank you very much. When would you expect rates to actually move? I mean, what's your gut? I mean, 14?
No, I never get in the business of forecasting interest rates. I was against the 2014 date for the following reason. Just putting a date out there isn't the issue. That's what we call time contingent. What I'm worried about is state contingent planning, meaning what's the state of the economy? What are the dynamics? What's happening here? And by just picking a date, it wasn't done, by the way, thoughtlessly. It was done with great deliberation. But it seemed to me that as you approach that date, you might want to expand upon it or contract it. And that would create a whole new impulse in the marketplace. And it just seemed to me to be not the way to make monetary policy. The way to make monetary policy is to make it based on the state of the economy and the dynamics in the economy, not just to pick a date. It was done to signal, when it was done, that we would be in a low interest rate environment for a long time. And I expect us to be in a low interest rate environment for a long time.
Let me wrap up on one more question here.
What is the downside?
So forget that there's a date. What is the downside to a prolonged period of low rates? Are we encouraging citizens to take inappropriate risks? And where do you see the next bubble? Because this is an extreme at 0%.
That's a very good question. There are costs and benefits to everything you do. One of the costs of a low interest rate regime is that those that played by the rules, those that saved, people that are getting older like me that shortened their risk and came in on the yield curve and just had their money in CDs and so on, which is what you're trained to do if you're a prudent saver, have taken it in the neck because they can't earn anything on their retirement savings. Theoretically, what you do when you come down to zero interest rates, what's called the zero bound, is you encourage people to take more risk. A lot of people, however, are afraid of taking greater risk because they've seen what happens in security markets, and it does run counter to the logic of what you should do as you age or as you should be constricting your risk. So that was one of the costs. We were well aware of it. I articulated that quite forcefully. We have to deal with pension fund exposure as well. You know, a lot of pension funds, particularly the state and local ones, the government ones, run on return assumptions that are no longer attainable. They're going to have to up, in other words, put more money into the system. How do you do that without depressing the economy even further at the state and local level? Corporations have to do that, those that have remaining defined benefits plans. So there are several costs that were involved that came from this very low interest rate policy. And then there's the issue of whether you're encouraging speculation or not. I'm going to make one other point which may upset some people in the room. But I worry, one of the things I worry about is we might be party to making the rich richer. And we're not helping, as I put it, the homers and the marges. We're helping the Mr. Burnses by a low interest rate policy. And I worry about that. That's a note that we ought to conclude on.
Okay, thank you very much, Richard Fisher. Thanks, everyone.